Imagine opening your banking app. You look at your credit card debt and you realize that even if you spend several lifetimes hanging over almost every penny you own, it's literally impossible to ever pay it off. Sound horrific, right? But that is exactly what the situation looked like for the world's largest economies today. Except instead of a credit card, it's national debt. And instead of millions, we're talking about over $350 trillion. The most fascinating part is that the vast majority of this money will never be paid back by the way people usually imagine. And this is exactly why global debt is considered one of the absolute biggest talking points for investors today. Tyler here. How does global debt actually work? Who is paying whom? And where is the money going? Why does the US national debt remain the primary nerve center for the entire global financial system? And what happens if the system breaks down in one day? And most importantly, why does all of this matter not just to governments and central banks, but to every single investor, trader, and regular person? I'll answer all of these questions right after you drop a like and subscribe to the channel. Let's go. National debt isn't some massive bill that someone is just going to step up and pay one day. The mechanics are way more boring, which actually makes them way more dangerous. When a government spends more than it brings in through taxes, it runs a budget deficit. To cover that gap, authorities issue government bonds. When those bonds mature, a portion of the debt is indeed paid off. But very often, new bonds are issued at the exact same time. But the debt never actually disappears. It just constantly rolls over from old issues into new ones. This is why the US Treasury, for instance, describes the national debt as the accumulated result of years of borrowing that is regularly serviced and refinanced. And at the same time, the metric system that matters most to investors is debt held by the public. The debt owned by private investors, banks, funds, and foreign governments. This is the exact debt that exerts the heaviest influence and interest rates and the financial market. Therefore, asking, will a country ever completely pay off its debt isn't even the right question. Most developed nations aren't aiming for zero debt at all. Their actual goal is to ensure that the economy grows fast enough to keep the cost of servicing that debt manageable. In other words, the problem isn't the debt itself. The problem arises when the debt becomes too expensive to service. And right now, that is one of the top themes across global markets. For example, according to OECD estimates, governments and corporations are projected to borrow roughly $29 trillion in the debt markets this year. On top of that, 78% of new borrowing by OECD governments will go towards refinancing existing debt rather than funding new expenditures. This means the name of the game today isn't even borrowing even more. It's managing to roll over old debts on time and at an acceptable interest rate. It seems like if everyone is doing it, and what's the big deal? The issue is that there's one specific debt upon which practically the entire global financial system depends today, and that is the US debt. Right now, the US national debt has already blown past $39 trillion, growing an average of about $5 billion every single day. To put that into perspective, you could literally buy small S&P 500 company every single day with that money. Relative to US GDP, it's already sitting above 120%. For comparison, the peak after World War II was around 106%. And back then, that was considered extreme. Right now, it's significantly higher, and the trend isn't reversing. And here's the key point. The US isn't just another country with debt. The dollar is the world's reserve currency. US treasuries are a risk-free asset upon which the entire global financial architecture is built. When everything is fine, this is the foundation. When problems start, this is the epicenter. Why is the American debt often called a ticking time bomb? Because it's simply too big to ignore. It's deeply embedded into the system to suffer a default without consequences, and it's too politicized to accept any reasonable solutions anytime soon. I have a couple of videos covering the American politics and the market, so make sure to check those out. What's truly wild is that about 70% of the debt is held by domestic investors and institutions, while roughly 30% is held by foreign entities. So the problem for the US isn't that one single player will pull the plug. The problem is that the largest debt market in the world will continuously remain the safest, most liquid, and most desirable asset out there. Otherwise, the cost of borrowing starts creeping up, and when the price of money creeps up, absolutely everyone feels it. The stock market feels it, mortgages feel it, business loans feel it, and yes, retail traders absolutely feel it too. When you put money into a deposit account, the bank doesn't hide it under a mattress. It issues loans, it buys bonds, including government bonds, meaning that without even noticing it, you are actively lending money to your own government. But how did the richest country in the world end up living on credit? The trick is that running a budget deficit has become the rule, not the exception. Beginners often come to me crying because of their future positions in down 2% for the week. Meanwhile, the US Treasury just issued $1 trillion in new paper simply to pay the interest on its old debts. Your 2% drawdown versus, well, you get the point. And this brings us straight to the ultimate question. Can they ever actually pay this off? And the short answer is, No. The long answer is they don't even intend to. Look, the logic of your credit card or my credit card simply does not apply to the world of sovereign debt. You and I are obligated to pay back what we owe. A government, however, can just issue new debt to pay off the old debt. It's called refinancing. They are just moving debt from one pocket to another. But there is a catch. The investors buying this new debt aren't stupid. They see that the investment payments are stacking up, so they demand higher and higher yields to even bother touching these bonds. And that's when the real fun begins. According to the estimated data from Treasury reports, over the last couple of years, US expenditures just for servicing the debt have surpassed their entire military budget. Just think about that. They're spending more on credit card interest than on the most powerful military on earth. The math simply doesn't add up. It's like running up a downward moving escalator. You are sprinting with all of your might, but you are still sinking. By the way, before I forget, if you want to break down these macro themes with a crystal clear focus and how to actually make money off them tomorrow, come join my Telegram channel. The link is in the description below the video. Every day I post my setups, entry points, and market breakdowns there. Zero fluff, just what impacts your trading account today. Drop a subscription, it's genuinely packed with value. Can you just keep accelerating this entire debt system forever? Or are we just hitting a point of no return soon? The most honest answer doesn't sound quite as sensational as you want for a YouTube thumbnail. This bomb doesn't have a specific expiration date. There is no big red button on the wall that says explosion on Friday at 2:30 p.m. The explosion won't happen because the money runs out. The US does not run out of money. They can just print it. The explosion will happen when nobody wants to buy their debt anymore, even at massive interest rates. Just picture this scenario. The Treasury needs to borrow $1 billion. They go to auction and all they get is crickets. Nobody wants to buy their bonds because everyone realizes that the inflation will eat up the yield and the debt itself will devalue. So what does the Fed do? Exactly. They turn on the printing press and they buy the debt themselves. They monetize it. And at the exact moment when the central bank becomes the sole buyer of its own country's national debt, real inflation kicks in. Not the kind where people complain about the news because grocery prices went up 10%, the kind that destroys the currency itself. The central bank forces financial repression, artificially suppressing interest rates to make it easier for the governments to pay its debts. But at whose expense? At the expense of your savings, at the expense of the dollar's purchasing power. That is its actual system failure. Not an outright default, but a stealth default via inflation. The debt doesn't vanish, it just dissolves into the printing press. So when you look at the charts and you see the Fed pumping liquidity yet again, you need to realize they aren't saving the economy. They're simply kicking the can down the road, paying for it with the purchasing power of your paycheck. And this is where you have to ask yourself a question. If the system is doomed, what are you actually invested in right now? If you understand the mechanics, you really only have two choices left. The first is to sit in cash and hope your dollars don't melt away faster than you can earn them. And to be completely honest, that is a losing strategy. The second path is to its own assets that grow along with the same value as printing press. But buying an asset is only half the battle. You still have to manage it correctly. So here are the three simple rules. First, never open a trade purely because a massive news headline dropped. Look at the price reaction first. The market's reaction is always more important than the headline itself. Second, keep a close eye on the US 10-year Treasury yield. Very often it is the first indicator showing where big money is starting to flow, whether it's into risk on assets or conversely, into safe havens. Third, if there is an upcoming Fed meeting, an inflation print, or US jobs data around the corner, lower your trade amount. On days like that, the market can move significantly harder than usual, and a trader's job is to survive first and make money second. And remember, one simple thought. The market is under no obligation to agree with your opinion. Therefore, arguing with it is the most expensive habit you can have in trading. What I really wanted to show with this video is that global debt doesn't mean everything is going to collapse tomorrow. It means a modern trader needs to understand more than just charts. You need to understand exactly why those charts are moving in the first place, and that is what gives you in the long term an edge. You can spend years trying to figure all of this out on your own, or you can drop a like and subscribe to my Telegram channel. There, I break down which events actually matter for the market every day, share my trades, pass along investment ideas, and explain macroeconomics in plain English. The link, as always, is in the description. Bye.